It's 2025 and the world of investing is constantly evolving. With AI breakthrough, change in the global economies and market trends, it's more important than ever to invest wisely. Philip Pfizer have rightly said, the stock market is filled with individuals who know price of everything but value of nothing. And I don't want you to be those individuals. So today we are diving into top 5 index funds that you can invest in 2025, funds that are designed to give you strong returns with minimal risk. We will break down each one, covering their expense ratio, dividends and historic performance so that you can make informed decisions. So if you want to grow your wealth, hit the like button, subscribe to this channel and let's get started. It will just take 1 second. First on the list is Invesco QQQ Trust, which tracks the Nasdaq 100. This fund is packed with non-financial tech giants like Apple, Nvidia, Microsoft, Amazon, making it a great choice for investors who believe in future of technology. With an expense ratio of 0.2%, which is you will pay $2 for every $1,000 invested, which is quite high in this case. This index fund is of high growth and high reward. With a dividend yield of 0.47%, in the past 5 years, dividend had grown from 0.43% in 2020 to 0.49% in 2024. According to CNBC, AI markets is expected to reach over $1 trillion by 2030. As AI continues to grow, QQQ is well positioned to take advantage of this growth. So if you are someone who believes in AI, cloud computing, computational research and automation in different industries, this index fund can be for you for long term. Next on the list we have SPY, the SPDR S&P 500 ETF Trust. One of the most popular ETF in the world, this index fund tracks S&P 500, which are the largest 500 companies in the United States. With an expense ratio of 0.9%, you will have to pay a fee of $0.9 for a $1,000 invested. Dividend in SPY has been constantly evolving with the current value of 1.75%. Over the last 5 years, dividends by SPY has been constantly evolving and increasing. So SPY is one such index fund that you can invest in if you really want to expose yourself to all the industry of the top 500 companies. SPY has proven to be a great choice for investors who want long-term investment. So if you want a broad market exposure and at a lower cost, this index fund can be one such great choice for you. Warren Buffett has famously said about SPY to his family that if I'm not around to give you financial advice, then go and put your money in SPY and forget about it. SPY will outperform majority of self-managed index funds and hedge funds and institutions because SPY consists of the top 500 companies in the United States, which has performed historically well and have outperformed majority of funds which are self-managed or managed by institutions. So overall, this can be a great choice for long-term investment if you are looking for long-term growth. Next on the list is VTI, the Vanguard Total Stock Market ETF. If you are someone who is looking beyond S&P 500 and you want to diversify your portfolio not just in large companies but in small, mid-size as well as large companies, then VTI can be an obvious choice for you. So this index fund includes over 3,800 companies from small, mid-size to large cap with expense ratio of 0.03%, which is you will pay an average of 30 cents for $1,000 invested. This index fund can be a great choice for you for a long term with low expense ratio and higher exposure to the entire US economy. Dividend from this index fund is around 0.99% and over the last 5 years it has fluctuated between 1.21% in 2020 to 0.99% in 2024. With such low expense ratio, VTI is an incredible option for investors who want to invest in entire US economy and at the same time pay less fee. Next on the list is VUG, Vanguard Growth ETF. Now if you are someone who is looking for high growth companies, then VUG can be an excellent choice for you. This fund is made up of companies which outperform the market and have a very high potential of growth. Think of companies like Tesla, Google, Meta. They have shown incredible growth over time. With AI making trends in different sectors like healthcare, manufacturing, and technology, VUG have a great potential for growth in the future. Think about the AI revolution with companies like Google, Meta, and Nvidia. These are all included in VUG. With an expense ratio of 0.04%, you will be paying a fee of $0.4 for $1,000 invested, which is like 40 cents. And if we talk about the dividend growth, it has given a dividend of 0.49% in 2024, but has not grown significantly. So you need to understand that the growth stocks reinvest their earnings back into the company, and that is why they have a lower dividend ratio. But at the same time, if you are someone who really believes in high risk, high reward, and you want to believe in the company with growth, then this index fund can be for you. And the last on the list is VTIAX, Vanguard Total International Stock ETF. Finally, let's go global. While a lot of investors focus on US economies, there are many investors who want to diversify their portfolio, and for that reason they invest across the globe. With the changing political dynamics, growing and emerging markets in Europe and Asia, there is a high potential for you to invest in international stocks as well. So VTIAX makes a lot of sense for those who believe in global markets. With an expense ratio of 0.09%, which is you will be paying around $0.9 for $1,000 invested, VTIAX has given dividend yield of 1.2%, and the dividend growth over the last 5 years have been steady depending on the markets and global challenges. This fund covers markets in Europe, Asia, and other emerging markets. With geopolitical risk and shifting global power dynamics, this index fund can make a lot of sense for investors who want to diversify their portfolio and want to invest outside of United States. So if you are someone who believe in emerging markets and global growth, then this index fund makes a lot of sense for you. So overall, I talked about the 5 index funds. Now I haven't talked about performance of those index funds. So let's dive deeper into it. But before that, I again repeat, if you have not liked and subscribed to this channel, do that. It will take a second. Now let's recap first of all. We have discussed about QQQ, tech heavy Nasdaq 100 growth, SPY, the go-to S&P 500 ETF, VTI, the full US stock market exposure including small, large and mid-sized companies, VUG, the high growth stocks for big potential gains, and VTIAX, global diversification for risk management. Remember, investing is all about balancing risk and rewards. If you want steady, long-time growth, index funds are one of the best choices that you can make instead of scratching your head on picking and choosing which stock to invest in. So which one of these index funds you are going to invest in? Hold on. I haven't discussed about performance in the last 10 years and 5 years respectively. So let me jump into it. First of all, look at the screen. You can see that QQQ have given an average return of 26.99% in last 5 years, while giving a 17.54% over the last 10 years. What does that tell you? QQQ is tech heavy. After the tech boom in 2020, it has constantly been increasing. And with the AI revolution and cloud computing and quantum mechanisms and automation and manufacturing by AI factories, this is all going crazy, and QQQ have really high potential to grow, but at the same time it comes with high risk. With SPY, it has given a constant return of 15.22% in last 5 years with an average of 14.28% in last 10 years. And if you talk about S&P 500 over last 100 years, it has given an average return of 8 to 10%. And that is why it is being trusted by majority of financial gurus that put your money in S&P 500 and forget about it. Now jump into the third one, VTI. VTI have given constant return of 14.56% over the last 5 years and 13.88% over the last 10 years. VUG, Vanguard Growth ETF, have given a return of 19.34% over the last 5 years and have given a return of 14.32% over the last 10 years. While VTIAX, which is the international stock ETF, 8.48% in last 5 years, while 7.02% in last 10 years. So as you can see, the top 4 have given double-digit returns over the last 5 and 10 years. This may not continue for future, but at the same time, I want to tell you that depending on your choice, you can invest, or you can invest in all of them at a certain percentage. Now the key takeaway I want to discuss with you. QQQ dominates the returns, and with the AI revolution coming up, QQQ is well positioned to outperform the market, but at the same time it has very high risk. You need to be careful about that. Next is SPY and VTI. SPY have given you exposure to the top 500 companies, and VTI gives you exposure to the total market index of United States. Majority of the investors who believe in long-term growth, they invest in these two index funds for sure, which is SPY and VTI. And the third is VTIAX, which gives you exposure beyond United States economy. So all of them can be combined together or individually based on your choice you can invest money in. Now let's compare a little bit. The last comparison I want to do among all these 5 index funds is risk tolerance and which is best for whom. So as you can see on the screen, that QQQ is high risk. Of course, it is more tech heavy, it's only 100 companies, and it can go in any direction depending on the market trends and the economy and also the political sphere. SPY and VTI on the other side, they both are at the moderate risk level and they have given a constant return over time, and they both are good for long-term exposure into the US economies. Now you have VUG. Again, on the risk scale, VUG is at high, of course, because it is driven by the high growth potential companies, which can also go downhill. So at the same time, you have to be sure that if you are a person who want aggressive growth and you are an investor who believe in high risk, high reward, then this can be for you. And the next on the list is VTIAX. As I mentioned to you, it has over 7,500 companies and it is at the risk level of moderate. And it is good for those who want to believe in international diversification. So depending on your choice, what kind of investor you are, or you want to be an investor who is a combination of so many types of investor. For example, you can be aggressive at the same time, you can be for the long term. So you can pick and choose, and at the same time, you can divide your portfolio into different index funds that I have discussed today. So by end of this video, my goal was to make sure that you are informed about the choices that you are going to make. And I hope this video helps you in deciding which index fund you really want to invest money in. It has been a pleasure that you have watched this video so far. If you like this video, please hit the like and subscribe to this channel for more videos on personal finance, investing, and growth. Thank you so much. See you in the next video.
I don't ever slow up, no I don't take shit. I got no love for the fakeness. If you wanna play tough and wanna hate this, I'll always show up. I don't ever slow up, no I don't take shit. I got no love for the fakeness. If you wanna play tough and wanna hate this, I'll always show up.